Welcome, it's the Market Sniper. Glad to be with you in 2024. Yes, it's the 10th of Jan. That's right. Glad to be with you. So, what are we going to be talking about today? Pensions. That thing that you expect is saving you, that's going to be giving kindly to you once you stop working. That aspect that's going to feed you, provide you with health, provide you with transport, provide you with lifestyle once you stop working. That's right. During this period over the year, many people will gonna have had Christmas, they will have had time with a family, they will have set their goals, they would have got positive and motivated. I'm hoping that's you. And then they would say, yeah, all these guys that doom predict and black pill type guys and all of this, yeah, everything's fine. The sun still comes up every morning and I get to work and I'm saving and I still have a job and all of that. I don't see these big drama outcomes that they keep making such a fuss about all the time. In fact, I'm going to carry on. I'm going to take one day at a time and I'm just going to carry on. And it's very easy to get sucked back into what I call the sort of normalization. It's almost like a hyper normalization. It's like, yeah, the bank's still there. I can still draw cash. Why do I have to hold more cash now? Every time I've gone, they've given me my $500, 500 euros, 500 pounds, 500 rands, 500 Aussie dollars, etc., etc. And why do I have to panic? Why stack gold now? I can stack it later if and when, when things seem to sound like they're about to go down and all of these things. So you get into the sort of numbness. It's like there's an intravenous numbing pain agent that is going into that bicep vein right there. And you're calm and nothing matters. It's kind of like a morphine, you're feeling good. And I'm just here to remind you that everything as we see it in the debt realm is 100% already completely broken. And they're actually literally holding things up on stilts to coordinate the crash at some agreed point in the future. In other words, this is a controlled demolition. The explosives are already primed. They are already instilled. They're on every major supporting strut in this borrowing fiat into existence money system that we have. And the plans, to great detail, that have been planned for many, many years, are deeply well advanced. That is where we are, everybody. In short, you are living in a shell on top of a massive cavity under the ground, and everything, both the building can collapse and the foundations can collapse into a sinkhole. There is so little of any long-term structural value. They are literally, to stop certain elements collapsing in advance, putting band-aids and holding things up until everything is ready to go. Who knows, that might be some gematria type date that they want to hang on till. They might want to coordinate various other things in terms of timing, but that is my statement on the situation. And I want to talk about pensions in terms of that today. And there was one tweet that I retweeted. Don't forget to follow @TheMarketSniper for your fundamental and technical take on the markets. And by the way, I'm not going to do much charts here. I want to just talk to you in person about sustainability and how everything is already broken and ready to fall. So let's just refer to this news article that I tweeted out. So here we come, the screen above. The second largest pension fund in the entire of America. That is the United States of America, one of the biggest, the economic driver of the world village in terms of the economy, may borrow more than, in other words, not less than. So by the way, 50 billion is more than 30 billion. It could be quite a lot more than 30 billion. So it's 30 billion plus to help it maintain liquidity. It's seeking to maintain liquidity without having to sell assets at fire sale prices. What, according to a new policy, its investment committee will consider this month. So hold on a minute. So you're a pension scheme and you get given a bunch of money throughout. Every single teacher that's ever taught 30 years deductions taken at source every month from their salaries, supposedly put somewhere into something to pay these retired teachers 35 years later some form of a retirement where their needs will be catered for. And what have you done with that money? Well, guess what? You probably bought what government sold you. In other words, you were part of the Ponzi money that was fake money, that was buying debt, buying government debt, T-bills, treasuries, etc. And you did this on an ongoing basis and got fat on bonds. And guess what happened? In the 80s, from the interest rate spike highs, those bonds went up and up and up in value. And the yield, beware, went down and down in value. So whilst you got paid less in yield, your capital appreciation was huge. So many of these funds concluded that they can do, in some instances, and I'm not implying in this case, but when the money was received, there were private funds in private companies that decided that they actually had a surplus. The portfolio performance was ahead of the requirements, and they took holidays, and those companies didn't put money in those private schemes on a basis that the capital appreciation was doing a lot of the work for them, and they didn't put the money. And then the market turned. The market then turned, and it's actually worth having a look at a chart which is the interest rates since around, you guessed it, 2007, when we went to peak bonds. In other words, the interest rates collapsed 2008, so that January 2009 you were barely above. This is the Fed's fund rates for the decade. That is essentially 9, and we're sitting here in 2024, a 15-year period where you only had to face one indiscrete moment up to about 2.38, only for it to come smashing back down with great vigor all the way back down to effectively near zeros. The Fed fund rate near zeros. So throughout that period, bonds continued to hold value and grow in value. However, the yield for them was less, so you weren't getting much income on those instruments. But, let's hope they reinvested. So popping back to the article, that was peak bonds period. What, of course, happened over here once the largesse of every asset bubble in the investment world had been pumped to the extreme, and they started to give money in furlough payments and business for the events of March 2020. You suddenly had an explosion in inflation, and this went along with the end of globalization, where you were also insisting now that everything had to be made locally, on friendshoring and everything else. So no longer was lowest cost of production, a la China, India, anywhere, or Vietnam, etc., the key driver. It was now, you've got to be a friend of the United States. What happened? Inflation exploded. We'd already had the asset price inflation. So inflation, by the way, is money printing, and it is a central bank policy. They intentionally refer to it to confuse people. They get you to believe inflation is prices going up at the till, and there was no inflation during Alan Greenspan's era when he was Mr. Liquidity Experiment, and all those that followed him, Shlomo Bernanke and Granny Yoda Yellen, and then who's now moved across to be Treasury. So you were supposed to be politically impartial, and now it's quite clear you align to a particular party. And now we sit with Jay Powell, and he's left to deal with these 5 chair people that have pursued all of these out of sustainably non-sustainable policies, of which Greenspan was the biggest culprit. So if approved, the policy will allow staff of the pension fund that is managing it as much as 10% of the 318 billion portfolio. The proposal calls for leverage to be used on a temporary basis. Temporary. Now, here's a word that really needs explaining. Anytime you're talking about status institutions, politics, governments, or pension funds associated with government type employees, public sector workers. The word temporary is the thin edge of a wedge to fit under the door. In other words, they are going to jam that door. Temporary today, but oh my goodness, the need has become so much bigger now. Not only can we not pay that back, but we actually need more to keep going. And we'll unwind this someday, much like they inflated the existing debt issue. Now you're going to have a pension borrowing against assets that's going to leverage off its existing assets, much of a debt itself, which is now losing value, and they're going to get ever higher percentages and ever more, because there's always going to be a liquidity experiment that is causing them problems right now. And we are seeing the contraction in liquidity because the debt valuations have lost substantially their value in a very short period. In short, that 318 billion portfolio, how to have a small fortune like 318 billion is to start off with 600 billion in the treasury market to find yourself at 318 billion later. So that 10%, I don't know how will allow them possibly 31.8. But then you might get the people that value things and say, it's not a fair valuation right now in these difficult, illiquid markets to value that bond at that amount. Under normal circumstances, it could be expected to sell. This is a bit like the goal or the game or the role that the rating agencies played during subprime. Oh, it's AAA, generally in a normal market, the search for yield. That asset will sell, it's secured against property. What's the problem? AAA, sign away, sign away, sign away. Only it's a ninja loan to a single mom in Detroit who has a crack habit, and probably the property will be worth nothing more than land value, which will drop immensely once all the entire neighborhood has gone through the same pump and dump scheme and is essentially a wasteland. But never mind, it's a $350,000 house today, and she can get that mortgage against those security checks. So it's kind of like that. And this is the second biggest pension. And I'm amazed. I mean, this article went out some time, and I haven't had a lot of time to cruise the YouTube, but I'm almost amazed how little this is being spoken about. Because essentially you're talking about, it's literally, in the UK, the NHS is like an army. The Californian Teachers Association is massive. They have schools and schools and schools and schools. It's the second biggest of the status pensions, and they do not have the money. And that's you can say, but no, they do. It's just not a good time for selling. When will be a good time to sell? How much do you think those bonds are going to appreciate in value? As yours truly, the Federal Reserve, with Granny Yoda, ex-Fed head, now on the Treasury, print, more money, high interest rates to pay, higher than the defense budget. What do you think she's going to do? They don't have the money either. You're not paying enough tax. They've been spending twice what they were getting in terms of tax. Now they have an interest bill that keeps getting higher. They're going to create more debt and monetize to pay off older debt. What does that mean? New treasury bonds, new treasury, a supply pipe as fat as this. And you, as Mr. Pension, want to come and sell into that. It's like a bad timeshare that a whole bunch of people all got sold, got scammed, and is near bankrupt and isn't looked after. And everywhere on every notice board, everybody's selling and there's no buyers. How do you think that market turns out? Well, if you get a mark to market and you take a super low price, they won't want to do that because they'll have to revalue their entire portfolio. And suddenly it's not 318. They had to get some cash and they sold it. And they sold it a bunch lower because the bid is absent and it's way down and it's super thin. So to meet their commitments of paying the monthly pensions to the teachers that have already retired and are entitled to them, they didn't have the money. In other words, where's all that yield gone? Probably reinvested in debt. Why can't they sell the debt? It doesn't have the value. If everybody in the debt market tried to sell their debt right now, you wouldn't need a fraction of a percent for there to go zero bid, 60% airdrop down. Guess what? If everybody did that. But of course, governments won't allow that. They will coordinate this and say, ooh, don't crash the debt bomb. We're not ready to hit the plunger on the controlled demolition. That is already done. You will continue to sustain. Must hold up a totally illiquid market that doesn't trade. And this is, and how different do you think it is for the first biggest pension fund in America? The other statist ones particularly, but even private pensions. Don't also forget that pensions often invested in long-standing stable assets, such as commercial real estate. That's right. We will have a nice offices in New York. That never goes out of fashion. That never goes out of style. Then you see the buses unloading the people, all the immigrants, the illegal immigrants being flushed in. They're all being sent to school gymnasiums. Schools are staying at home because there's illegal immigrants being processed in your school gymnasium. People are freaking out about the crime in New York as the South says, hey, you can have the illegal immigrants. We don't want them all down here. And they can't chase it away because of leftist policies, because of BLM, because of love. Who's bringing in all these people? Who's bringing all these people into Europe? Who's bringing all these people into the UK? Why are they not going into Israel? All sorts of interesting questions about the progress of illegal immigrants into countries that one may or may not even ask. Nonetheless, these are new citizens in an attempt, illegal ones that are being brought in an attempt to maybe fix a demographics problem, but there's also increasing a crime problem, also seeing shutdown of cities and seeing loss of interest in the commercial real estate. If you have second tier commercial real estate in New York or in the outer lying areas, not closest to the tube, little bit dingy, little bit rough, area, your asset is losing value and you're sitting on terribly low occupancy, terribly low desire for space. Where are all these new startups that want New York access? People are working from home. People don't want to go into the offices anymore. You're seeing this whole cycle change, and they did it. The people that are orchestrating this crash did it. They did it with the events of March 2020. Stay at home. They made you stay at home. Other businesses, such as Amazon.com, got free advertising on the newspaper, on the news about all the amazing steps that they were taking to provide goods and items and everything else, while SMEs got killed. Smaller retails got killed. And what does that lead to? A dearth of commercial space. A dearth of commercial space, lack of desire. People conservatively estimating that commercial real estate has lost 20%. Tons of free space. If you signed a new 5 or 10-year lease at any of these places, and it's not just, I've mentioned New York, it can be any urban area on the periphery, that is losing value. It is losing value fast. Higher interest rates, lower occupancy. Bad formula. Bad for the margins, negative margin. You pay to retain the assets, get very little stipend rental in, many of them demanding years for free, depending on the term of the lease. You may never see that income coming in. This is what pensions have also invested in, apart from the bond market. We've always considered, those in the financial world know that the dumb money is the pension manager. Often in institutions before these things were segregated, the unit trusts, the mutual funds that were competing on return would stuff all their worst assets and all their mistakes into the pension fund. Why? Because they were opaque. Over 30, 40 years, they might correct themselves. People didn't get unit value updates, etc. on a month-by-month basis. There were no bragging rights on your pension is outperforming XYZ's pension. And as a result, the garbage got put in there. And guess what? In many instances, garbage stays garbage. It doesn't alchemize into gold. Anyway, so you're sitting with this. What else is going on? What are the headlines? US pension. This is just the headline from the Financial Times, the pink paper that I refuse to subscribe to. I refuse to give them a single penny. But I will tell you, US pension plans warned that they will run out of money in 2028. So we said quite some time ago that reset is likely to be this potential year on account of all the 4-year cycles, the quantitative easing cycle, the election cycle, the Bitcoin halvening cycle, and many other aspects. But there are a lot of things that are going to be completely out of money means zero. That means they've spent their last dime. Unfortunately, things tend to close up before the last dollar is spent. People realize the trajectory isn't good. You know, when you have 100 billion, then 30 billion, then 5 billion, then 100 million, and then 5 million. You know, they've closed the business long ago when you have the liabilities of paying a monthly pension. They all freak out, they all throw their hands in the air, and they say it's over. What is happening if you talk about James is quite some fun to follow. If you talk about debt and the central banking cartel and his comment. In the last year, the ECB created a anti-fragmentation tool. Now that is very gobbledygook speak, I can tell you, for hopelessly attempting to support different debt markets. The BOJ became the largest owner of its own government debt. That is consuming your own feces. You are essentially creating it and now you consume it. There is no buyer. There is no buyer. We'll be looking back at the demographics on all nations, including Japan, on another chart in a minute. The BOE rescued UK pension funds from collapse. That was all blamed on Truss. She did a stimulus budget that would have seen them running and building more debt, which would have seen more debt come into the market, but would have also stimulated growth in the economy. I actually think it was probably the right idea. You have to push. You are supposed to, governments are supposed to dip into the overdraft in the bad times. They're not supposed to run overdrafts permanently, even in the good times. You're supposed to, in the bad times, run an overdraft, get growth going, stimulate the economy, and thereby get higher tax receipts because you're giving tax cuts to business creators. You need the entrepreneurs to be incentivized to build businesses, hire people, take a rental on a commercial office, etc., etc., etc. All tax takes go down. But anyway, I'm no fan of her or her finance minister, but it was the BOE's mistake of not moving interest at the same rate as the American, in my opinion. And as a result, people thought, hey, I can hold British gilts, which pay a lower interest rate, or I can hold American gilts that pay a higher interest rates, and the dollar's beating up on the pound. Guess what happened? More the pound went down, the more people sold the pound, the more they bought treasuries and dumped UK debt. Guess what happened? A pension fund showed up and had a no bid situation. Now they're not allowed to crash the market. They can't just go, damn, we got to get something. Just drop your pants all the way down the bid and ask stack until we've fulfilled. Why? Because that would crash the market and create a super spike and would be a confidence shattering illusion. You would be hiding you would be pulling back the curtain on the great illusion of liquid sustainable debt values. And of course the government steps in and says, oh no, don't do that, don't do that, don't do that. Must keep the conjuring game, the shadows on the wall going, the fire must be kept alive. Ooh, scary monsters. Look at the wall, look at the wall. This is Plato's cave, of course, I'm referring to, and it is the illusion of debt having value. The illusion of debt in the end of its lifetime as a Ponzi scheme that is being absolutely proliferated, having value. What else is being spoken about? Oh, yes, the British pension fund correction and shock, and the US Treasury emergency backstopped all bank depositors, insured and uninsured. This is a healthy monetary system. That has less to do with pensions, but it also shows that the illusion extends to your deposits with your bank. And it's only for as long as they commit to underwriting that as saying, okay, we're sustaining this broken system a little longer, prop it up a little longer. We're not yet ready to hit the plunger and say, oh, it got too big. Sorry, guys. Black Swan event. Oh, it's all fall down now. Damn. Never mind. UBI will compensate you. By the way, have you had your recent medical intervention to qualify for the full 100%? No. Oh, bad boy. There goes your credit score. There goes your UBI percentage, all coming to you during the course of this next setback. But there's things you can do. It's not all negative. There'll be opportunities too. What else is going on? What else is going on? The retirement crisis. Let's look at this chart on the retirement crisis. So 2020, well, we don't have to look out as far as 2050. That's the dark purple over here. But the trend is what you should be worrying about long before getting there. I mean, most of us don't care. At my age, if I'm still batting and knocking around in 2050, I'll be as happy as a clam, probably high on morphine and charging around on a Zimmer frame. But anyway, that's 30 years off from here, around, well, 26 years off. It'll be going quite good. The average age, the number of retirees per 100 working people. So this number go up means greater weight, greater amounts that need to be paid on by the 100 working people in tax to fund their elderly. So the younger generation bears the burden of the older generation, pig in the python, baby boomer, and the Gen X are the cynical ones that now have to pay for those that had so many lovely bubbles for them inflated and now sitting saying, give me my welfare, give me my Medicaid, give me my everything. So that's going from around 28 years to over 40. Well, you'll have broken long before then. 40 pensioners carried by 100 guys. That's a lot. Think of the entire salary that's needed for an elderly person. If there's 100 of you paying for 40, I mean, that's your tax take, assuming nothing else. Imagine how much tax those 100 people have to pay to keep 40 old people alive, fed, housed, and medicalized. That's assuming no other reason for tax. There's not the usual military industrial complex, the roads, all the other things that you've got to pay for. It's unsustainable. United Kingdom currently at 32, got to go to 47. It's the trend. It's the trend you got to watch, guys. It's the trend. It'll all be over well before 2050. In short, I think it'll happen even this year. China at 18.5. Look at that growth. That is a huge growth. They're super low in 2020, and now they're going to be a lot higher. France already at 37.3. The French aren't having babies right now. So this was 2020. We're 4 years into this trend. We're 4 years into this trend. It's probably already at around 40. Given that they just don't have the children. Germany, not much better. Italy. It's absolutely awful. I mean, this is laughable. The notion that 100 people would have to sustain 74 people. It's literally every person can just be given an old dude to walk around with, and you just shell out every time he needs something. He needs a nurse to wipe his bum, you pay. He needs to go and get his medis, you pay. You just literally get given an old guy and you just shell. Every time he wants to go to the store, every time he places a bet at a tote on his favorite horse, you're shelling out. It's literally 100, because of that 100, that assumes, you know, all of them will be high income workers. If you're, of that 100, the bottom third are low income workers. So it's the, you know, it's the next, the 66 that will be carrying the 74. You literally will have a pensioner and a half if you have a half decent career over there. I mean, it's ludicrous. Spain, not different. South Korea's rate of decline is unbelievable. In 2020, even though that was low, it is absolutely spilling it. Japan, I mean, what need we say? They're already there. They're already well past there. 52 pensioners have to be carried by 100 working people. And as I've said, they're not all, there's taxi drivers in there, there's street cleaners in there, there are all sorts of menial jobs, there are burger patty flippers in there, they aren't all hedge fund managers, they aren't all doctors, they aren't all surgeons in that 100. So I mean, that is the sustainability of pensions, and I would argue this absolutely is over, game over, and it won't take as long. Bringing it to South Africa for a moment, you've got service pensions. You're in recession right now. The 50 is typically the indicator on PMIs when where business employment is going down. You can see it over here, around about the 50 mark. The official recession was called as you were about to tip below the 50 mark, recession. So that was the recession of 01 to post the dot-com boom. That's the dot-com boom recession. That's the subprime recession, which dipped really low. Of course, this one dipped even lower. It's the one we may not name, of March 2020. And then you're back up, and here you are crashing through. It is recessional. Most of these were just playing with a 50 line. That is a proper break to the downside. You are already in the next recession in South Africa, and I'm saying to you, it's the same for America, despite their lies, damn lies, and statistics. And that is an emerging market that has debt in dollars. So what else have we got on the pensions comment? Well, let's talk about the creation of debt. And the biggest creator of debt is mortgages for retail. The biggest debt instrument that a retail person has is typically a mortgage. And what's kind of interesting right here is, let's go back to that interest rate one more time. So you can see, boom, that was 2020 through to 2022. And this was 2008 to 2015. So if we just take most of this period, from 09, most of it was at exceedingly low rates the debt was issued. There was, okay, a kind of a mini recovery in yields, and there was a sell-off in the debt markets around here for 18 and 19. Some of those people would be paying slightly higher rates, but the high was 2.4. So all of it is substantially lower than where we are today. Most of it very close to the Fed fund rates at zero. So you weren't paying zero. Of course, the banks like to make money, but people were paying low rates of interest. So if we go back to 09 and we just have a look at this, we don't even have data for it, but let's just take this. You have 18% here in 2020. So if we just take the pandemic from 2009 into what we have so far, there's no data on 2023 of any significance. Most people got mortgages. 6%, 18, that is 24. Plus 23.4, let's just add the 23, we go 47. Plus 12.6, that's almost 13. 47 plus 13, 60%. So in 2019 to 2022, not taking any of 2023, 60% of all US mortgage valuations. So the portfolio of everyone who has a loan on their home, the total value of issuance was during the 2019, 2020, 21, 22 period. So people were given cheap debt. Why? Because the rates were low. Back to the rates charts. 219, here we go, 219, 220, 221, 222. That's where your rates were low. Let's just put the box in the right place. You kind of came in here. So we've got 60% of mortgages. That is a investment. That's right. That loan that those people got for buying that home is somebody else's investment. Somebody else's investment is that loan. And you're in the environment economically that we're in. The debt is absolutely unsustainable. Everything is ready to fall. It is being propped up. It is 100% being propped up by the system, and it is unsustainable. So for you watching this, what do you do? What do you do? Well, your pension is probably invested in debt. So look at me here. Your pension is probably invested in debt. Get it out. By the way, what do you think this does when money dies? If debt and bond markets has a super crash, you get an interest rate spike. You can't survive if the rates spike too high. And even those that are on fixed debt, there are all sorts of clauses they can cheat you on. There are other debts that you'll have that may be on variable or it won't last. As the valuation, my elbow, of debt goes down, the rates will spike. If you get a spontaneous collapse where government is no longer in a position or they've decided to just walk away. This is exactly like the Euro Swiss franc. We said it was going to collapse and everybody said no. Every time it comes to 120, they buy up the bond, the euro, and they sell the franc. And the central bank is right, and it's market manipulation, and it's a cheap and easy trade to buy 120 point, couple of pips, 19 pips above the 120, and then it gets a bump away. You're making free money every time it came. And then it traded 120, 119.99, 119.93, and then everybody mass sold and it just fell. And then there went no bid. It went no bid. the call we made on the euro Swiss franc. We made 3 calls. One is live now. 2, one in 2009 and one in 2015. It went no bid. Entire brokerages went bust on this. IG index lost, I think, 500 million USD. Saxo lost 80 million pounds and got a lawsuit for restating fills after the liquidity providers. Who are the liquidity providers? The primary dealers, the major investment banks, Goldman Sachs and all of them. They continue to auto-bot provide a feed and then they just cut it. They said they walked. The Swiss has walked. How far will it fall? A whole long way back down. Go and have a look again at the euro Swiss franc chart. It went no bid. It opened up a whole bunch down. Entire brokerages went bust because clients, many clients that were longing it had too big, much larger than their deposits in terms of costs and losses. They just walked. Of course you would. Why wouldn't you? And the brokers can try to chase you up for money they never had. Their game is to always ensure they have sufficient margin that they never become a creditor who has to chase a client. It was such a collapse that the losses were so huge that even people with reasonable margins were absolutely decimated. It happened so fast. There was no bid and they just walked. But you would say, why would they do that? Why didn't they coordinate with the euro? Because the European Central Bank didn't want euros. They were pumping euros. They didn't want to buy them back in. They were trying to get them out, pumping euros to fill holes in bank balance sheets. Did the Swiss, had they eaten enough? Sure they had, and they'd had enough. And it's, of course, it's part of one of the biggest secret services hubs with a square flag. Go and investigate that. Topic for another day. And the Swiss just walked. Why? Because they want soundness. They wanted a bit of soundness in their own currency. And we are still short the euro Swiss franc. Let's maybe have one teeny weeny chart. We'll go euro Swiss franc. It wouldn't be a sniper video without one. We've said this and it's a long-term trade. Look at that new low recently made over December when no one cared. 29th of December, 0.92. 0.92. This is the call. And these were the previous calls, by the way. And that is what a no bid market does. You see that one candle? It was an absolute rainmaker trade. I'll take that off for you. That was your 1.2 floor. The risk-free trade. The risk-free trade that saw you trust a central bank. Now, anytime you're in a situation where you're expecting to trust a central bank, who are behind the debt markets? Central banks. Central banks. A whole bunch of them. All coordinated and all owned by the same people. So you wonder why I say this will be synchronized? That they walk and they say, no mas, no more, kanimieni corporal. That's what's coming. They won't allow, they won't continue, they won't support, and that is the outcome. On a currency, you go from 120. This wick has been restated many times, but the low was 0.96. We told you would run the parity again on an inverted HVF, and that has happened. It has happened, and we've given you a 0.87. We gave it to you up here. This is a slow deterioration of one holding country that is tied to the European economy, that is based in banking, that has the central bank to the central banks, Bank of International Settlements, that slightly purports to pursue more sound policies, although still a central bank, still a Ponzi and proliferation, still had super low rates and a very expensive property. And they are winning out. Their currency is winning out against the euro, and you have a 0.87 to do, and you've done nothing but go down, and you could have got in at 1.08 and watched it and held it long term. Or have you been holding dollars? Have you been holding euros? You could have just held Swiss francs. You can open a Wise account and you can have an account and just rather hold Swiss francs. That's just one small thing you can do. Now, I personally prefer saving in gold. I prefer saving in a couple of other investments that might go up further. But you need fiat. Why not just have fiat in a Swiss denominated in Swiss francs? This is one of many ways on this channel that we've tried to help you save the loss of value in your currency. If you have to hold a fiat in a bank, Have a wise account, have yourself that. But eventually the banks go down. You need notes, you need cash, and you need gold, and you want it physically. And this is why we continue to reiterate, the pension system is gone. Forget your pension. That which you can't touch, that you can't get your hands on, will not be worth what you think it is. They are the patsy in the room that have allowed government to pursue proliferation strategies. Your pension payments were an additional tax of pay as you earn at your point of receipt that got taken away from you in the name of a promise to someday look after you in your pensions. You must live for now, not for your pension. You must live for today, not for your retirement era. You must save for yourself, not in trust of statist organizations. You must diminish what they take from you and put more of it in an organized, structured way, in sound investments yourself that you understand, that you control. And that is what we aim to specialize in for all our community members. And gold and silver is part of that. But there's fear on equities, the great taking, and many other things. You really need to own your certificates. There's so many ways they can catch you. The game is to think about it for yourself, take control yourself, get support, and actually start winning out properly, building wealth during 2024, getting you to your goals, because there will be huge opportunity for the people that have preserved capital, not sought yield, but preserved capital, the return of capital rather than the return on capital. Those winners will be picking up things for a song when they blow this up. When they hit that plunger, you will get opportunities. There is very little room for them to print and pretend any longer. Let's go to one final tweet. Actually, Raoul Powell posted an interesting tweet. Let's go and find him. And there he is. And this tweet over here. This is absolutely accurate in my opinion. All nations are in a fact funding debt growth in excess of GDP. What does that mean? So the productive value of a new dollar created, in other words, I borrow a money into existence, I create a debt instrument, and I create an asset that is the money that can go buy things. The rate at which that is expanding is faster than the actual economic value of it. So it's no longer productive. The GDP it generates is only 0.3 for every one I'm creating. In other words, they are debasing and they are not creating fresh new value. Not new businesses that are creating salaries, new employment, new tax takes from people that are creating products that are actively being bought and sought after in offshore markets and locally. They are all monetizing their interest payments since 2008. Listen to that phrase one more time. They are all monetizing. What does that actually mean? That means they can't make their payments on its own. The money they already borrowed into existence, the interest required thereon is seeing them need to create new borrowing to serve that interest. This is you getting new credit cards to pay the payments on your existing credit cards and to continue your lifestyle. So you have a credit card, you've run up to the limit, the payments are X, you're only earning half X, and you are creating 2 or 3 new credit cards with new limits where you pay the other half X, and with the rest of that you are living beyond your means again on those 3 cards. And then those 3 cards interest bill come in and you get 10 new credit cards and you pay the interest on the 4 that you already have. It starts running up those limits on those 10, on all 10 of those, and you continue to live on that, borrowing again and again. How long do you think that would go for you? That's where your economies are. They are monetizing their interest payments. They are using debt to pay interest on a previous debt. Borrowing from Peter to pay Paul. This is the peak fiat mega trend. GMI, Total Liquidity Index. And why did it slow here? Because of interest rate hikes. That's where it's come. That's why it's been slowing for a wee bit. It had a major surge growth as a result of March 2020. You all know about that. And we saw all the QEs, what that did as a result of 2008 through to 2014. That was just a mega 1, 2, 3. That phrase created by, you guessed it, Professor Werner, covered with us here on this very channel. Go and watch that. With regards to Japan, who was the first to do quantitative easing, he named the phrase and gave them the cause or the reason why they might do it, to bring back their economy back into kilter. Only they did the QE, but they didn't do all the pain stuff that went with his recommendation, and as a result they ended up being all borrowed up and now doing yield curve control as best as they can, which we'll still see the yen be one of the worst performing currencies for an extended period beyond, and the yen hedge equities be great value investments. But anyway, that was a YouTube clip of another day. So Raul's clip, his tweet, a very interesting tweet, and this is the driver behind gold. This is the driver behind crypto. This is the driver behind a number of things. We're only just starting this global liquidity cycle, and it already produced 50% gains in the NASDAQ, 150% gains in BTC. Remember, Bitcoin went up on quantitative easing generally. We're yet to have the huge quantitative easing surge. This is all during a tightening phase that Bitcoin is moving up. So there is good scope there. There's going to be even better, I think, in terms of your safety against grid and mobile network, to have gold and silver. While it won't do this absolute return, it will be even more safe and secure in your grubby little mitts. So that's where we are for 2024, guys. It's a state of the nation address that I'm giving you here. It is me talking to you in your kitchen. I even got my 1940s kitchen right here. There's a smeg here. You can see all the utensils. Beautiful, lovely little Airbnb rental here where we can do great habits. We're really enjoying it, right by the sea, having a good life. It's time you got your best life. It's time you took steps to invest, to prepare yourself for all these aspects. Get control over your pension. Get it out of those assets. Get it into physical gold, get it into physical silver, get it into equities where you will hold the share certificates in your name for those shares, only when you can do that, and get it into a select bunch of the mega cryptos. And by the way, for investing in crypto, we did a tweet on the Crypto Sniper. Don't forget to follow us on @the Crypto Sniper if you're not following the Market Sniper and the Crypto Sniper on Twitter, or X as it's called now. Quite dubious about that name and its origins, but nevertheless, that is the Crypto Sniper. Here's something to bear in mind for you on investing in the bull maximization secrets for investing in crypto. No to very low investment leverage. Do not blow up. These are high volatility instruments. Let me say it again. Low to none. Investment leverage. What would be low? Like 0.25, like adding 25% to your pot, maybe scratching in the best moments 0.5. Never chase momentum. FOMO. Never get in and chase the momentum up. Don't do it. You must value your entries. If your entries are good, you survive. You can survive immense volatility. If you are deleveraged and you are patient, own 85% of investment in the top 15 by market cap. So this is an example of this. And I'm talking to you, this is actually a crypto discussion now in some senses. But for investing in anything, this is what you should bear in mind. The stable coins should be removed. So that's not number 3. The USDC is not number 7, but you should be in the top 15. 85% of what you do should be in the top 15. You should keep a certain amount absolutely in cash, so you can have a 5% pure speculation pot. If you have 100 grand, have 5 grand and put 1,000 in transhuman coin. Some other high, for whatever reason that you think it might succeed, because it's some status game. A little bit of Pulse, a little bit of Hex, who knows, whatever you want. But then have 85% at least in your top 10 actual cryptos. It's top 15, but by the time you've eliminated the stable coins, it's mostly top 10. And you must be skewed to the top ones. You know, Bitcoin, Ethereum, XRP, BNB, those ones at the top, ADA potentially. 10%, keep some powder dry, keep some powder dry. You're going to get opportunities, even when you're thinking, damn, I could be that little bit more in. It's not about maximization, the pump. It's about optionality, having a couple of options that you can then make use of. There will be gifts along the way. You get hard smackdowns at key moments. Play the long game. Be one of patience. Patience in the crypto markets. This also applies for all investing vehicles, which is why I'm talking about it. It just applies double for crypto because of the volatility and the fact that many of the youthful participants have no patience. They have no timeline. Make sure, match your timeline. This one is not in. I almost hate the fact that it's not in. I need to retweet this and put this one. Have your goals and your expectations match the timeline. In other words, your expectation for success and outcome, your patience must be like that. If you're entering and you think in the next year to two, we're having a bull market which will peak, give it the year or two. Don't jump out after 3 days after a nasty little sell-off. You must have the time. If you're going to be that skittish and you're going to be on a short time frame of action, but on a long time frame of perception, you are not matching. There is a mismatch in perception. Match the time frame of your expectations by your trading investment strategy. Make the two match. They've got to turn at the same rate. If you're in a 4x4 and you don't have a slip differential and one wheel's turning faster than the other, the car's about to skid. It's getting out of kilter. It's getting out of order. Major dips do happen, even in bull markets. They're part of the landscape. Don't be startled by them, rather exploit them. How do you exploit them? Have ridiculous limit orders with, that's why you need that stable coin valuation, and you can even have that 10% be up 15% with real collapse buy options in them. Great investment entries generally. Try be early. Yes, and it is still early. This is at the dawn. Most people don't realize it's all going to fall down. You're realizing it. You're putting your crash bid entries in. You're also stocking up on your best ones. Those are a couple of ideas. Okay, so that's what are we spoken about today? We're going to finish up. Don't forget to click the link below to be part of our community, to join us with regular updates from me, yours truly, the Market Sniper, the Crypto Sniper, and the Reset Sniper. Book a call below. Dom, there you go. What did we talk about? The unsustainability of the pension system. The unsustainability of the debt system and mortgage housing and how much of it has been created. The fact that the central bankers are all monetizing at a faster rate than their corporations, aka their nation states, are actually growing. In other words, they are borrowing their future payments into existence to make those payments and then using the leftover money to spend and create ever bigger payments on what is a very high interest rate, more likely to go up in a super spike than to collapse because the debt valuations are going to go down. They are holding a phony market. There is no bid. There are pensions that have no bid. The Bank of Japan has had no bid. They have made banking deposits whole. There is an unsound situation. Without the coordinators, these markets would have already collapsed. They are holding it up until they're ready to clean the slate. Don't be part of the cleaning. This is your message. Okay, until I catch you next time. Thank you for watching your kitchen broadcast from yours truly, the Market Sniper. Share it out, get it out while. This is not a game. Don't go back to hyper normalization. In your goals that you should be writing, in your book with your little pen, should be your saving strategy of how much you're going to put away into the likes of gold, silver, crypto, and other investments such as real estate, unencumbered by debt. Remember that. Unencumbered by debt. If you've got a lot of debt on your balance sheet, don't forget to retire it as soon as possible. Okay, until next time, I'll catch you later. Thanks for watching. Have a great 2024 and stay subbed. Remember to hit notify all the time on our channel. Until next time, catch you later. Bye for now.